Hello everybody, and welcome to a third episode of Business Concepts. In this episode, we're still going to be talking about procurement and sourcing concepts, and here are the 5 topics. Let's move on to the first one. Three-way invoice matching. What is a three-way invoice matching? That's a process of matching what was received by your company via a purchase order to an invoice that was sent to you by the vendor. Right? So the receipt we already talked about, that's basically physically receiving things that you ordered. You created a purchase order, you send it to your supplier, and supplier shipped you these goods that you received in your warehouse. So that's a receipt. Invoice is basically getting a paper or getting a document, can be via email, fax, etc. Getting a document from a supplier that's saying, we shipped you this, and here's how much you need to pay us, right? And it may be terms, you need to pay maybe in 15 days, in 13 days, etc. So this process is called three-way invoice matching. So what is actually matched to? So why it's called three-way? So the reason why it's called three-way, I think, is because it's really looking at 3 documents, and that's why it's actually kind of looking kind of 3 ways. So the first document it's looking at is the purchase order that you originally created. So a while ago, you created a purchase order that says, here are the products that I would like to order from you, here are the quantities that I would like to order, and here are the prices that I'm willing to pay, right? So you have product, quantity, and the price. So that's the first document. The second document is that product receipt. So basically that's when you physically get those products registered in your warehouse and registered in the system. So that's called product receipt. In some systems it's called packing slip, but that's basically a second document that it reviews too. And the third document is, as I mentioned, is the vendor invoice, basically saying here's what the supplier expects you to pay and for the quantities it expects you to pay for. So what are the things that are usually looked at? The first thing is usually looked at is the quantity. So does the quantity on the invoice matches to the quantity on the product receipt? So basically, does it mean, does the supplier charges you for the quantity that you actually received, right? So if you received, for example, 20 pallets of some merchandise, is vendor charging you for 20 pallets, or maybe for some reason they're charging you for 30 pallets. What complicates that matter is that sometimes you may have multiple receipts against a single purchase order, so you have to make sure that you include all the receipts, 2 or 3 different shipments that you received, because maybe you will get just one invoice from that supplier for the same, for multiple receipts, right? So you got 3 different shipments, 10 pallets, for example, and then you're going to get one invoice that says, by the way, pays for 30 pallets. So yeah, your system has to be capable of understanding that there may be multiple shipments that were sent and therefore matching to those receipts. So quantity is the first thing that actually is matched, quantity on the invoice and the quantity that you have received. And the second thing that it's matching to is the prices. And the way it looks at is, does the price per unit matches to the price on the original purchase order, right? So we have 2 documents again. So we're looking at the price that is specified on the vendor invoice, and we're comparing that price to what we actually entered in the purchase order, right? So sometimes you agreed and you think that you would pay $5 per, for example, per gadget that you are ordering from a supplier, and then you get an invoice that says, oh, you owe us $6 per gadget, right? So that's where the discrepancy may come in, and that's where you kind of can flag that invoice and say, I will not post that invoice right away. I will not process it for payment because I found some discrepancies. The prices are not matching, or for example, quantities are not matching. Sometimes you may say, oh, I'm fine with the discrepancy as long as it's in my favor, right? So if I expected to pay $5 per gadget and for some reason the supplier is charging me only $4.50 per gadget, it's a discrepancy. It's a different price on the invoice versus the purchase order itself, but you may let it go just because it's in your favor, right? So sometimes you can configure the system to say, yes, if there is a difference, as long as it's in my favor, I will let it go and I will process that invoice for payment. Sometimes you may say, no, the price have to be exactly what I've entered on the purchase order. So basically, that's in a nutshell a 3-way invoice matching process. Let's talk about the second topic, vendor returns. Vendor returns is basically sending merchandise, sending those items that you received from a supplier back to them, right? There may be multiple reasons. Maybe the items were damaged, maybe the items are defective, maybe that the items were damaged or not as described, etc., right? So you need to basically say, all right, I've got something in my warehouse, I looked at it, I processed, I did some quality checks on it, and now I feel that I cannot use that merchandise, it's defective, it was damaged, so I need to ship it back. So in many systems, you may, for example, just create a purchase order with negative quantities. So if a standard purchase order says 5 pallets, 5 positive number I would like to receive, in many systems you can create a purchase order with negative 5 pallets, for example, that basically says I'm not going to be receiving these 5 pallets in my warehouse, I will be shipping them back. Right? So that's just one way of looking at it. Sometimes it may be a separate format, maybe a separate document that is created that is called vendor returns that you create in a system that basically does the exact same thing. So the end result here is that you need to subtract that inventory that you already received or registered in a system and move it out, because that inventory should not be visible to any of your planning processes as something that you can use, for example, sell or use in a production order, right? So for that, you usually need to obtain something that's called a return authorization. Some call it RMAs, some call it return to vendor, etc. So you need to maybe get some sort of number that from a supplier, from a vendor, that would allow them to easily process that return physically and then give you a credit for the purchase, right? So you call them, describe the problem, they agree that it's their fault, they shipped you a wrong product, for example, and they give you an RMA number. You can use that RMA number on your vendor return order in your system, and that RMA number then will be printed on paperwork that you send back with a driver or for that came pick it up, or maybe with your own driver. So the idea here is to do two things when you complete that vendor return order. The first thing you need to do is, as I said, is to make sure that the inventory that may have been already received on that purchase order and is visible in our warehouse, in our on hand inventory list in our system, is deducted, is basically subtracted from that list. So if I receive these 5 pallets, and if I understand that, for example, 3 of those pallets cannot be used, and I'm planning to send those 3 pallets out, I need to make sure that my inventory on hand list does not show 5 pallets, but it's actually reduced and only shows 2 pallets, because only 2 pallets are truly usable and can be used in the system. The rest have to be sent back, right? So that's one goal of that vendor return order, is to make sure the inventory list is updated and the defective quantities are sent back and deducted from your on-hand inventory. And the second purpose here is to make sure that you have a credit with that vendor, right? Because the vendor may already send you an invoice the same day saying, oh, by the way, you owe us for 5 pallets of these goods. So you owe us, for example, $500. But the reality is you don't want to pay $500. You only want to pay for those 2 good pallets, let's say $200, right? So what you're doing that by creating that RMA is you creating basically a credit note that says, yes, I owe that vendor $500, but also they owe me $300 back for those 3 pallets that I'm sending back. So these two numbers have set each other, and the balance actually remains $200. Now let's talk about the third topic, which is delivery versus normal PO, right? So sometimes you, as a distributor, the company that actually does not do anything with materials, they just basically buy them from one place and sell them to another place. That's a definition of a distributor. Sometimes you may prefer, for some logistical reasons, to ask your vendor not to send those goods to you where you touch them and then send them to your customer. You may choose to, for example, ask your vendor to send the goods directly to the customer, right? So that's what called a direct PO, or direct delivery, right? So in this case, you are issuing a PO. You're basically saying, Mr. Vendor, here's what I would like you to send, right? Here's the quantity, here are the prices, but the delivery address will not be the address of my warehouse. It will be an address of the customer warehouse, or a customer address, right? So that's a direct delivery PO. So what you do in this case, you create a special type of a purchase order, as I said, direct delivery PO, that says, this is what we will pay, this is what we would like to ship, and then here's where we would like to ship it to. What the subplot here is what you need to be aware of from financial perspective is something that is called markings, right? What is markings? it's basically marking the cost of what you paid to that vendor to the cost of sale that you're going to have to that on that related sales order, right? Keep in mind that the whole trigger here is a sales order. You're still going to have a sales order in your system to charge and invoice your customer, because your customer will pay you even though the vendor ships directly to your customer. So the idea here is that you're going to create a sales order in your system that says, here's what I will charge you, Mr. Customer. Let's say, come back to and say, I will charge you $500 for those 5 pallets, right? And I will pay my vendor, let's say, only $300, right? So let's go back. Let's just kind of show a different example. I will charge you, Mr. Customer, $1,000 for 5 pallets, but I will pay $500 for these pallets to the vendor. So the idea here is you're going to have a sales order that will say, here's a customer, 5 pallets, the total charge is $1,000. And then you're going to create a direct delivery PO that actually is a linked to that sales order, right? Because the whole reason why that direct delivery PO exists in the first place is because you have a sales order from the customer. So you're going to create another document, direct delivery PO, that is linked to that sales order, and that PO will have a cost of $500, because what you are doing is you are charging a customer $1,000 for 5 pallets, and you're paying the supplier $500 for the same pallets. So in this case, you have this relationship, and that's what is called marking, that basically says, all right, I will make sure that whatever you pay to that vendor, in our example, the $500, will be marked as the cost of sale against that sales order. So it's easy to calculate that in the example that I just gave you, the profit margin is $1,000 that you charge in your customer minus $500 that you are paying to the vendor, and that will be your profit margin of $500. Right? So the marking process is important to make sure that the costs are actually marked and actually linked between that PO and that sales order. Because the reality is, if you did not create that direct delivery PO, maybe the cost of your inventory of the same item may be different, but because you're creating a direct delivery PO, you're basically saying, yes, I have an inventory that costs me not just $100 per pallet, but for some reason, let's say $90 per pallet, but I don't want to sell that inventory. I would like to sell and buy that inventory from the supplier right now. So basically that's a replacement cost, and says, here's what I will charge you for. So if you have markings, then the cost will be marked to that sales order. So the cost of sale will be marked to that sales order. If you don't have markings between those two documents, the sales order and the direct delivery PO, then the cost will not be marked. And what the system usually can do is look at your on-hand inventory value, the averages, and say, okay, the average cost per pallet right now should be not $100, but $90, or let's say $110, right, without the markings. All right, the topic number 4 is vendor collaboration. So what is vendor collaboration? It's a portal that suppliers can access, usually like an internet portal, B2B portal, where they enter their credentials that you provided to them, and where they can actually do a few things. They can review the purchase order that you sent to them. So instead of you sending emails with those PDF attachments that describe what you would like to buy from them, they log into your portal and they see the orders that you placed with them, right? So they can review those orders. They can maybe suggest some changes, right? They say, oh, these dates are not reasonable, so let me just change them by 1 week. Those prices are not correct. We've changed our price list. I'm not sure why you're using those prices. So here are correct prices. And for example, they can change the quantities. They say, no, we cannot ship you half pallets. We will only ship you full pallets, right? So there are multiple reasons why they would want to change these, right? So they basically review those and make some decisions on it. They can accept the orders as is. They may reject the orders straightforward, saying, well, no, we are no longer making this product, etc. They can also, for example, go and generate an invoice, right? So instead of them generating their system and then emailing them to you, they may go in, for example, to say, okay, here's what I would like to invoice you for. It's a very uncommon function, but it still exists in some systems. They can also provision users themselves. So for example, yes, you gave me an admin access to that vendor collaboration portal, but I would like to add my clerks, my employees to that portal so they have access as well, right? So they can maybe manage their own products. And the third function of that vendor collaboration portal is me as the supplier can update my personal information. So company name, registration numbers, tax numbers, delivery addresses, etc., right? So that's basically 3 main purposes of a vendor collaboration portal. All right, and let's move on to the last topic for today. That will be our vendor consignment. So the vendor consignment is an idea of you having a physical possession of something, but you are not financially owning that inventory. So that's what's called consignment inventory. So the typical example is that you need some consumables, right? So consumables are things that are used, for example, in a production that are not inventoried items. It's some sort of earplugs or maybe some gloves or any type of equipment, like maybe paper for the printers, right? You still have to pay for it, but you don't want to see how many stacks of paper and how many earplugs you have in your on-hand inventory. So those are consumable items, expensed items, right? So the idea here is that the vendor physically ships them to you and say, yeah, I shipped you 25 cases of earplugs, right? So you need to know how many earplugs you have. You need to see in your inventory that you have 25 cases of earplugs for some reason, right? Because you don't want to run out of them. And then you may use them slowly but surely. Maybe once a week you update and say, yes, I just used half a case today and then half a case the next month, etc. So you kind of deplete that inventory level. And as you deplete those at some period in time, maybe once a month, you need to pay for what you have consumed, right? So for example, at the end of the month, out of those 25 cases that were shipped to you, you used 2 cases, right? So now you need to basically create a purchase order and say, Mr. Vendor, out of those 25 cases, I actually used 2 and I will pay you today for 2, right? So I will create a purchase order, or maybe I will create a vendor invoice that will pay you for those 2 for those 2 cases, right? So the idea here is that the inventory, you still have those 25, or in this case 23 cases, but you are not paying for them all when you receive those. Whenever you receive them, you just updated your system saying, yes, I got 25 cases and I can use them if I need to, right? But I will not pay for them anytime soon. I will only pay for them as I use them, right? And then at the end of the month, let's say you use 2 cases, and that's when you will make a decision to transfer the ownership and say, all right, so I now own those 2 cases that have been used on my production, so I will create a purchase order or a vendor invoice in my system that will pay for those 2, right? So it's just convenience to a company, and many vendors do that just to get their business. Many vendors even come to your facility from time to time and replenish the inventory levels for you instead of you making those decisions. So they will come, visually check how many cases you have and say, all right, maybe you need extra case here, etc. So some of them are using some vending machines to do that. So basically vendors is doing that as a service to you as a company, as a convenience service, and they basically are responsible for making sure that you have always this sufficient quantities that you use as needed, and then they will come sometimes, or you make a decision when and how much you consume, or they will see in the vending machine how many earplugs were used, and they will invoice you at the end of the month. Anyway, so that's all for today's session. Hope you enjoyed it, and until then, next time.